Hello and welcome to this special Kranesahres focus on investing in the carbon markets. I'm Julian Marr, I'm Editorial Director of Wealthwise Media, and I'm very happy to be speaking to Luke Oliver, Head of Strategy at Kranesahres. Hello Luke, how are you doing?
Very well, thank you.
Let's get into the nitty-gritty straight away. Why is now the right time, the opportune moment to be investing in carbon?
Well, right now, we're in this sort of historic reset in carbon prices. A lot of people don't know a lot about carbon markets, but it's a $1 trillion asset class. And we're seeing the family offices, we're seeing the institutions all making allocations into this market, and yet it hasn't really made it into more mainstream portfolios. So go back 2 years, we had some of the best performing markets, both in European carbon, California carbon, and those prices have been reset through Ukraine invasion, huge spikes in gas prices that we saw as a result of the Ukraine invasion. We also had political shifts in the US that have moved a few things around that have pulled prices of carbon back to levels from about 2 years ago when we saw these great performance. So the market is sort of teeing itself up for a return to normalcy, and that return to normalcy will mean these returns start to pick up again. And just for those that don't really know what the carbon market is, the carbon market, this is nothing to do with forests or carbon capture, any of these things. What it is the market price mechanism that is in place in the European Union, in the UK, the state of California, which itself is the seventh largest economy in the world, the northeast of the US, and also, and these are the markets we cover, there's also China, New Zealand, Australia, South Korea, and so on and so forth. So what this is where they have a price mechanism where they issue these carbon allowances, which are essentially permits to pollute, and any company operating in those economies have to buy those credits. If they pollute 1 million tons of CO2 into the atmosphere, they have to go and buy the permits. So we're not getting long carbon like a commodity, we're getting long the economic value of producing a ton of carbon. And that is, as I say, has grown to be $1 trillion allocation, $1 trillion market that is making its way into more and more portfolios. And people are very interested because the return expectations are high, the correlations are low.
Is the exposure futures-based or is it physical? And could you explain the pros and cons of either?
Yeah, well, it's a great question. We're neither swap nor physical, which we think is the optimal place to be. So when you're buying a swap, so swap-based products will tend to have a swap on the underlying futures, and you get some layered costs in there. Physical, on the other hand, might seem like the place to go, but to get the physical exposure, you usually have to buy and trade the futures to get there, and then you're in a less transparent, less liquid vehicle. So when you buy the futures directly, as we do, and manage the futures, we're not layering in the costs, and we're operating in the most liquid part of the market. The futures is where the price discovery is, and that's where we operate. And what is often overlooked is people think futures curves, are they expensive? Is they contango? Well, the futures curve for carbon is much like a currency. There's no steep curve based on the transport or storage of a commodity. It's simply the cost of capital because futures are levered. We're not levered in our fund. And so we buy the futures. We have a cost of capital embedded in that future. We only have to post a small amount of margin. Most of our capital we get to put into ultra high quality, ultra short duration fixed income, and we earn back most of that. So there's a very small net carry in the futures curve, but it's not an expensive way. So we've got the liquidity, and we've got a modest price point to get that access. So we find futures to be the optimal way to access this market.
Thank you for that. How does carbon generally, your strategy more specifically, fit into client portfolios, would you suggest? And as a sort of sub-question to that, do you see this as an impact investment, or are you thinking of it in a different way when you're talking to potential clients and investors?
Yes, well, investors talk to us about it in some different ways.
Right.
And the way we think about it, first and foremost, without doubt, this is a classic alternative investment. Right. You have a Sharpe ratio similar to US equities, so a plus 70 Sharpe ratio versus around an 80 for US equities. Double the return, double the vol, give or take, but the correlation is only 0.3, which is incredible. You have this very low correlation, but with the same sort of risk profile as US equities. That is first and foremost what people find very attractive about this. Secondly, it's also probably the most impactful investment you can have, but it's not a prerequisite. It's not you should invest in this because it's good for the planet. You should invest in this because of the risk and return and low correlation. But you're also having an incredible impact because the way carbon works is as the price of carbon rises, and the design of this market is to rise in real terms above inflation. That is the catalyst for investment into green technology and into making dirtier fuels less attractive, cleaner fuels more attractive, and it encourages corporations and governments to shift their operations into lower carbon intensity processes. So very impactful, but it's not a prerequisite for investing. This isn't just for your green, sustainable investments. This is for any portfolio. So I think that was the second part of the question, and the first piece was more about
where it fits in. When you're talking to clients, where does it fit into the portfolio?
Exactly, and so that alternative allocation makes a lot of sense. Mm-hmm. That's the classic place people put it. The other place people put it is they just say, well, this is a replacement for commodities. Either we want less of the fossil fuels, or the fact that commodities don't really have a real return. They're a good diversifier, they're a good inflation hedge, but they just really move with inflation. They don't grow in real terms. Carbon is designed to rise in real terms. So if you replace commodities, it's a very simple switch. You actually move your efficient frontier out for all the reasons we've described. Another place, of course, people just look at this and say, well, we know that this market is expected to post returns above large cap equities, and we're interested in that story. And we've also had people who have said we're pulling back from things like ESG and SRI and things like that, but we want to have an overlay on the portfolio. So being long carbon provides that overlay without having to drop sectors out of your portfolio. So alternative first, sustainable sure, commodity replacement sure, overlay to hedge climate risk in your portfolio works as well.
Last question, just to pick up on something you said there. You mentioned fossil fuels, you mentioned dirty fuels. A lot of discussion at the moment about natural gas versus coal. Is carbon the way to position for this then?
Yeah, well, this is a really interesting shift. We know that, especially in the US, there's been a backlash on the ESG. We're generally seeing people less focused on that and keeping their risk return hat on more, which of course is in play here. But there's no doubt that we are going to burn less coal relative to gas. Of course, India, China, they're still building coal-fired power generation, but it's on the decline. Gas is going to be that interim fuel, and we're seeing volumes of oil trading shifting to natural gas. So naturally, a lot of people want to also maybe play, how do we play the transition to natural gas? Natural gas futures, incredibly expensive to hold. So we're starting to see people use European carbon as a way to play Europe's move towards more natural gas and less coal, because it's a cheap way to be long that growth. There's a relationship. As the price of carbon goes up, you have more switching from coal to gas, so gas goes up. If gas goes up, you're going to see some backpedaling with relationship with coal that's going to push carbon prices higher. So that positive relationship of gas and coal and carbon makes carbon a really effective way to play that transition. So that's an emerging use case for our products.
Nick Oliver, thank you so much.
Thank you so much.
And thank you very much for watching.